This mistake costs Canadian couples $3,000 plus a year. Right now, thousands of Canadian senior couples are opening their notice of assessment and getting hit with a tax bill they didn't see coming. And here's the part that stings the most. It's not because they earned more money. It's because one spouse's pension went on their tax return under their name only, pushed their net income past the OAS clawback line, and quietly wiped out hundreds, sometimes thousands, of dollars in GIS payments for the household. If you're 65 or older, married or common law, and one of you has a pension, a workplace pension, a RIF, an annuity, and you're filing your taxes the way you've always filed them, you could be handing money back to the CRA that you're legally allowed to keep. Every single year. And most couples don't find out until the damage is already done on the notice of assessment. I'm John AJ, and on this channel, we break down real CRA updates and Service Canada rules for Canadian seniors. No jargon, no fluff, just what actually affects your checkway. If you haven't subscribed yet, hit that subscribe button right now so you never miss an official payment update, because CRA doesn't send you a warning before your GIS drops. Today I'm walking you through one specific CRA form. It's called Form T1032, the joint election to split pension income. It's completely legal. It's been available for years, and most retired couples in this country have never used it. Not because they don't qualify, but because nobody ever sat them down and explained it in plain English. By the end of this video, you'll know exactly what it is, exactly what it's worth in real dollars, and exactly how to file it before this year's tax deadline. Let's get into it. Part 1. Why one name on the pension slip is costing you money the problem. One income, two people, one tax bill. Let's set the scene. This is Ontario, a retired couple. We'll call them Ron and Carol, ages 68 and 66. Ron worked 30 years at a manufacturing company and has a solid, defined benefit pension paying him $42,000 a year. Carol didn't have a workplace pension. She has her CPP and OAS, and that's it. On paper, Ron looks well off. His net income on line 23600 is high enough that he's creeping toward the OAS recovery tax threshold, what most people call the OAS clawback. Carol, meanwhile, has a low enough income that she'd actually qualify for some guaranteed income supplement. Except the CRA and Service Canada don't just look at her income. For GIS, they look at combined household income for a couple. GIS is calculated on combined income, not just yours. Here's the part that catches people off guard. Even though Carol has almost no income of her own, the fact that Ron's entire pension sits under his name doesn't lower the household's combined tax exposure. It just means Ron pays tax at a higher marginal rate on the full amount, and the household's reported income structure doesn't take advantage of Carol's lower tax bracket at all. That's money left on the table every single year. And for couples closer to the clawback threshold, it can also mean less OAS in Ron's pocket and less room for GIS top-ups. Now, I know what some of you are thinking watching this. John, is this some loophole that's going to get me flagged by the CRA? No, this is not a loophole. This is a formal, published, CRA-approved election. It has existed since 2007. It is filed every single tax season by hundreds of thousands of Canadian couples. There is nothing risky, aggressive, or gray area about it. The CRA built this specifically because they recognized that retired couples often have very lopsided pension income, and it wasn't fair to tax a household harder just because the pension checkway happened to arrive with one name on it instead of two. Part 2. What is Form T1032? CRA Form T1032. Joint election to split pension income. So let's break this down properly, using the three things you actually need to know. What it is, what it's worth, and how you get it. What is it? Form T1032 is a joint election, meaning both spouses fill it out and sign it together. That allows the spouse with higher eligible pension income to allocate up to 50% of that pension income to the lower income spouse, on paper, for tax purposes only. The money doesn't actually move out of anyone's bank account. Ron still receives his pension checkway the exact same way he always has. What changes is how that income is reported to the CRA. Up to half of it gets reported as if Carol received it. The money doesn't move. The tax reporting does. That one shift does three things at once. Number 1, it lowers Ron's line 23600 net income, which is the number the CRA uses to calculate the OAS recovery tax. Lower line 23600 means less chance of clawback, or a smaller clawback if you're already over the threshold. Number 2, it moves income into Carol's lower tax bracket, which means that chunk of income gets taxed at a lower rate overall for the household. Less combined tax paid. Number 3, Because it can lower the household's combined net income calculation used for income-tested benefits, it can help protect or even increase GIS eligibility. And in some provinces, it can affect eligibility for provincial senior supplements and drug or dental benefit programs that are also income-tested. And before someone in the comments says it, no, this is not the same as CPP pension sharing. That's a completely different process through Service Canada, using a different form, and it actually reassigns your CPP retirement pension itself. T1032 does not touch CPP or OAS at all. I'll explain exactly what income qualifies in a minute, so stick with me, because this is the part that trips people up the most. Part 3. What actually qualifies? This is critical, so let's slow down here. Eligible pension income for splitting includes payments from a registered company pension plan, what's called a registered pension plan, or RPP. This is Ron's defined benefit pension in our example. If you're receiving income from an RPP, this is eligible for splitting at any age, even before 65. RAF withdrawals, registered retirement income fund payments, are eligible, but only if the person receiving them is 65 or older by December 31 of that tax year. Life annuity payments from a superannuation or pension fund also qualify, generally with that same age 65 rule applying depending on the source. Certain payments from a registered retirement compensation arrangement can also qualify if you're 65 or older. CPP and OAS are not eligible for T1032. Now here's what does not qualify. And this is the mistake I see in the comments on this channel constantly. Your regular CPP retirement pension does not use Form T1032. Old age security payments do not use Form T1032. If you want to share CPP income with a spouse, that's a separate Service Canada process called CPP pension sharing, using a different application entirely, Form IS P1002. Don't confuse the two. Someone fills out T1032 expecting it to touch their CPP. It doesn't do anything to that income, and they think the form didn't work. It worked exactly as designed. It just wasn't meant to touch CPP or OAS in the first place. Let's address the skeptical question I know is coming. John, if I do this, will it hurt my GIS instead of helping it? Fair question, and the honest answer is, it depends on your specific numbers, but for the vast majority of couples where one spouse has significantly more pension income than the other, splitting brings the household's combined taxable income down, not up, because you're moving income into a lower tax bracket rather than creating new income. The CRA's own T1032 worksheet actually calculates the optimal split percentage for you automatically. You're not guessing. And critically, you are never required to split the full 50%. You can choose any percentage from 1% up to 50%, and you or your tax software can test different percentages to see which one produces the lowest combined family tax bill and the best GIS outcome. Part 4. What is it actually worth? Let's put real Canadian dollars on this, because vague promises don't pay your hydro bill. Scenario 1. Ron and Carol in Ontario. Ron's pension income is $42,000. Before splitting, Ron pays tax on the full $42,000 at his marginal rate, while Carol's tax bracket room sits mostly unused. By electing to split, say 40% of that pension, around $16,800. Over to Carol, that income now gets taxed in her lower bracket instead of Ron's higher one. For a couple in this income range, that kind of split commonly saves somewhere between $1,800 and $3,200 a year in combined federal and Ontario provincial tax, depending on their exact numbers. That's not a one-time saving. That's every single year they keep filing the election. Scenario 2. A retired couple in British Columbia closer to the OAS clawback threshold. Let's say the higher-earning spouse has net income sitting close to the OAS recovery tax threshold, which for the 2025 tax year sits around $93,454 and adjusts slightly most years. If splitting pension income drops that spouse's line 23600 below the threshold, or reduces how far over it they are, that alone can preserve thousands of dollars in OAS payments that would otherwise be clawed back at 15 cents for every dollar over the line. Combine that with the direct tax savings, and some higher income retired couples save well over $5,000 a year using this one form. Potential savings, $2,000 to $5,000 plus per year. Scenario 3. A lower income couple where GIS is the priority. If the receiving spouse's income moving in the right direction improves the household's overall combined net income calculation, it can help preserve GIS payments or increase the GIS top-up amount for the lower income spouse. For a couple depending on GIS as a core part of their monthly budget, even a modest improvement here can mean real grocery and hydro bill money every quarter. Now someone's going to ask, why didn't my accountant tell me this? And honestly, sometimes it's simple oversight, especially if you're using a basic tax filing service or doing your taxes yourself without specialized retirement software. Good tax software and good accountants who specialize in retirees almost always run this calculation automatically. But if you've been filing the same way for years, self-preparing, or using a general purpose preparer, this can absolutely slip through the cracks. That's exactly why I'm making this video, because it's not complicated once you know it exists, but it's completely invisible if nobody ever mentions it to you. Part 5. How do you actually file this? Here's exactly what to do, step by step. Step 1. Confirm your eligible pension income. Gather your T4A slips for RPP pension income, your T4RIF slips for RIF withdrawals, and any T4ARCA slips. Confirm which spouse has eligible income, and confirm whether the RIF holding spouse is 65 or older by December 31 of the tax year. Step 2. Decide who is the transferring spouse and who is the receiving spouse. Only one joint election can be made per household per tax year. The higher income spouse is generally the transferring spouse, allocating income to the lower income receiving spouse. But you can only test this properly using the actual worksheet, which brings me to Step 3. Step 3. Get Form T1032 from the CRA. You can find it directly on canada.ca by searching T1032 CRA or your tax software, whether that's TurboTax, Wealthsimple Tax, UFile, or a paid preparer software. Will generate it automatically once you enter your pension income and mark your age and marital status correctly. The software will typically run an optimization that tests different split percentages and shows you the one that produces the best combined household result. Step 4. Both spouses must sign the form. This is not optional. It is called a joint election because it legally requires agreement and signatures from both people. If you're filing on paper, both signed copies get attached to both of your individual T1 returns. If you're filing electronically, your tax software keeps the completed T1032 on file, and you should keep a signed copy for your own records in case the CRA requests it. Deadline. Same as your tax filing deadline. Step 5. File it with your tax return by the deadline. For most Canadians, that's April 30 of the year following the tax year. If either spouse is self-employed, the deadline extends to June 15th. File both returns together with matching numbers on both copies of the T1032. The CRA cross-checks that the transferring and receiving amounts match on both returns. Step 6. Verify it on your Notice of Assessment. Once the CRA processes your return, log into your CRA My Account and pull up your Notice of Assessment. Check line 23600 for the transferring spouse. It should be lower than it would have been without the split. You'll also see the elected split pension amount reflected on line 21,000 as a deduction for the transferring spouse and as additional pension income for the receiving spouse. If those numbers match what you filed, the election worked exactly as intended. I want to be really clear about something before we wrap up, because I get this question every time I cover a CRA form. This is not a one-and-done thing. You have to file Form T1032 every single year that you want the split to apply. It does not automatically carry forward from last year's return. So if you did this last tax season, don't assume it's already handled this year. Check with whoever prepares your return, or confirm it yourself if you self-file. And one more honest note. This isn't the right move for every single couple. If both spouses already have similar income levels, or if splitting would somehow push the receiving spouse into a higher bracket or threaten their own GIS eligibility, the math might not favor it. That's exactly why the worksheet exists. Always run the actual numbers for your household rather than assuming, because every couple's situation is different. What to do right now. So here's your one action step coming out of this video. If you're 65 or older, or your spouse is, and one of you has meaningfully more pension income than the other, a workplace pension, a RIRF, or an annuity, go check whether Form T1032 was filed on last year's return. If it wasn't, bring this exact form number up with whoever prepares your taxes this season, or if you self-file, look for the pension splitting section in your software before you submit. This single form has the potential to keep thousands of dollars a year in your household instead of sending it to the CRA, and it's been sitting there, legal and available, this entire time. Form T1032. Ask about it before you file. If this video helped clear things up, do me a favor and share it with another senior couple in your life. A neighbor, a sibling, someone in your seniors group. A lot of people are overpaying simply because nobody ever explained this to them in plain language. Drop a comment below and let me know what province you're in. I read every single one, and it helps me know what CRA and Service Canada topics to cover next for your area specifically. And if you haven't already, subscribe to the channel so you catch every update on CRA rules, GIS thresholds, and OAS clawback numbers as they change. I'm John A.J. I'll see you in the next one.